Hi everyone, this is Dimo Gonzalez of Heartwood Financial Services. Hey, thanks for joining us for our latest market update and outlook. So today's video is titled Fed Pause Winning the Tug of War. Now if you watched last month's video, I was talking about the Fed pause and what seems to be an imminent recession. What is going to be the more powerful force? Well, so far it feels like the Fed pause is winning. So we're going to get more into that and why, and of course, as always, our outlook and implications. Let's get started. So here are the asset class returns as the end of May. We obviously don't have the June numbers yet, even though we're in the middle of June. But I wanted to highlight everything still looking pretty good year to date, as you can see in the green, except for small caps, real estate. They've still been taking a little bit of a hit. And you can see for the month of May, it was actually kind of a down month. It wasn't horrible, but it wasn't a great month. And a lot of this is because the anticipation of what's going on with the debt ceiling and the next CPI number, all those things that have recently developed. So we're going to talk about that next in the market update. All right, so first of all, the agreement between White House and Congress has been reached for the debt ceiling. A lot of people didn't think it was going to happen, but it did happen, and it happened right at the end of the month. And what they actually did was not really solve the problem. They just kind of kicked the can down the road, just like they always do. They did a suspension of the debt ceiling for the next 2 years. And what happened is there's also going to be a freeze in most of the spending, not all. Defense spending is still going to go up 3%. But at least they're going to try to slow down spending a little bit. But as we'll talk about more later, it's probably not going to be enough, but at least it's moving in the right direction. And of course, the market had a big sigh of relief over this because that was one piece of uncertainty that's off the table. Now, this just happened last week, very recent. CPI number came out again, and it came down further. So we had 4.9% in April, and now we're down to 4%. And this is what they call the headline CPI. It includes everything. Now, when you look kind of under the hood and the things that don't have as much volatility like food and energy, those core numbers, they were a little bit stickier and actually a little bit higher. So the Fed is still kind of worried about that and cautious. But you keep seeing the inflation number come down. That is giving a lot of relief to the markets. All right, the last thing for the market update is the Fed had their meeting last week, and they finally did a pause. Now, a lot of people are calling this the most hawkish pause ever because they said they weren't going to raise interest rates at least for this month. They're going to keep it at 5 to 5.25. So yay! But what they did say is they still see inflation as a problem, and they're most likely going to keep raising rates maybe another 2 times. We shall see. We'll get more into that into the outlook. But as you can see, the markets have been very happy about this. This is just another piece of information that is giving tailwinds to the stock market. All right, so as you can see, there's been a lot going on with the markets that have had a pretty big impact on the stock market. And so now what I want to get into is the outlook for the next several months. And the natural question that one would ask is, now what? Now what is the Fed going to do? And again, I focus on the Fed because they have so much power on what's going on with the markets. And so is the Fed done raising rates? Well, I have my hunch that maybe they actually are, even though they said they're not. And I'm going to make 4 points of why I think that is and what the implications are. All right, number 1, I think this is actually my strongest case. Inflation has been coming down, as you saw from the Market update, we went from 4.9 to 4, and I believe the next month is going to be dramatically lower as well. It's going to be in the low 3s because we have a really big number because June was the peak in 2022. That's going to roll off. And so very easily we could be in the low 3 range. And I think that's going to give the Fed a lot of leeway to go ahead and leave interest rates the same. Okay, point number 2, the futures market. This shows the futures, what they think is going to happen to interest rate over the next several years. And right now we're at 5 to 5.25. So you can see that the futures market is essentially saying we're going to stay flat, and then we're going to probably be going down towards the end of the year or early next year. So these are the markets where people are actually trading and putting real money. This isn't just economist predictions. These are actual trades where they think the interest rates are going to go, and they're putting their money on the line. And so I look at this with a little bit more gravitas than just some prediction from economists. All right, point number 3, as you can see by this chart here, this shows the deposits at banks. And after this March, we won't call it a crisis, but we'll call it a debacle maybe, of what happened with the banks in the spring. As you can see, the deposits at banks have been going down. Now recently there's been a little bit of an uptick, so that is good to see. But for the most part, for the whole year, deposits have been going down. And that's because the interest rates available to consumers with T-bills and money markets are so much more attractive than what you can find at banks, at savings and CDs at banks. So people are yanking their money out. So if the Fed keeps raising interest rates, it's only going to make it worse, which could potentially create more, debacle, maybe crisis with the banks. So I do believe the Fed has a very close eye on this, and they're very concerned about what further rate hikes could do. Of course, they're not going to say this out loud, but this is the reality. And point number 4, this is the unfortunate truth, guys. We have so much debt that now the interest, just the interest on our debt, which higher interest rates make it even more costly, is going to surpass our biggest discretionary spending item, which is defense. Now, it doesn't look like it's going to pass it this year or maybe even next year, but it's going to start getting pretty close. Now, these are projections from the Congressional Budget Office, as you can see here. But I think it could actually even be worse if the Fed keeps raising rates. So I think the Fed sees this too. Of course, they're not going to talk about this because they don't want to get people more concerned than they have to. But this is going to limit the amount of Fed rate hikes they can make. And so again, they're going to be looking for every opportunity to pause, and they're going to maybe talk tough, but the actions are really what's most important. And I believe the pause is here to stay. Okay, so here's the bottom line. If the case that I'm making about the Fed being close to done, if not done already with raising rates, then what happens to the market when the Fed is done raising rates? Now, this is a chart that shows a few different cycles going back to 1995. And you can see here that the next 3, 6, and 12 months, for the most part, is pretty good. You can see 35%, 95, 21% in 06, 28% in 2018 after the first year. Now, it's not perfect. There was 2000 when the market was down, and so that can happen, and that will lower the average a little bit. But more likely than not, when the Fed is done raising rates, there's a higher probability that we could see some positive performance. And I think that's what the market's been sniffing out here over the last few weeks, which is why we've seen the market start to perform a lot better. All right, so as you could tell, I have been pretty positive in this video because there's some good developments that I'm seeing that could override the potential of the slowdown that either is here or is to come. but I'm still very anxious about the slowdown. I think it's something that we can't completely ignore. So I'm not jumping into the deep end quite yet with the overall allocation. But I have made some changes. Instead of aggressively selling down some of these more cyclical stocks, kind of put a pause on that. The Fed paused, so I'm going to pause. I'm going to continue to add to the large cap growth. That has been working and will probably continue to work as long as the interest rates stay where they are and maybe go down. I'm going to continue to add to the higher quality bonds because, again, that's going to add that little extra protection against recessions. And the interest rates are a lot more attractive than they have been in a long time. And I'm mostly bringing that from cash. Now, these are small moves. I'm reducing cash a little bit. Cash still looks very attractive, but with bonds looking more attractive, especially with rates not going as high as they were, they maybe have hit the peak. So bonds are going to do a little bit better. Stocks are going to do a little bit better. And I'm going to wait for maybe a few more months of what's happening with inflation before I really start ramping things up a little bit more in the small caps and the more aggressive bonds. So for right now, playing it pretty cautious, but leaning into a little bit of risk. So thanks for watching, guys. I hope this was helpful, and God bless.